I know that in the stock story today, we're talking some about Hong Kong, we're talking some about economic data. I mean, Hong Kong in and of itself would not necessarily be a big deal for U.S. stock investors, right?
You wouldn't think, but look, it comes at a time when concern about the slowdown in China is, pretty much front and center in a lot of people's eyes. You look at these videos, they do sort of look a lot like the Arab Spring videos we saw, so it's a scary thing, but you're right, the real backdrop is, look, the market's gone more than 3 years without a significant correction or drop of more than 10%, and that just, every time there's weakness like we saw last week, it makes people think, okay, is this it? Is this the big one? And obviously, the Fed's hanging out there in the background is a concern too. It's a very tough thing to model, this end of stimulus, and there's not a lot of bottom-up information. There's like 4 S&P earnings reports this week.
We talked about this last week, and that sort of doldrums in between earnings reports. I mean, Lisa, at the same time, it's not like the Treasury market's behaving as though the Fed's going to be raising rates anytime soon.
Well, the Fed has come out, and I mean, on one hand, they're saying that the economy is accelerating and that they do see, the potential to hike rates next year. At the same time, they're also saying that the strengthening dollar, which is a direct result of their starting to consider tightening monetary policy while other nations and central banks are not, is potentially going to inhibit growth, which is a concern for the Fed. So, it's kind of a floor on, or a cap on how high yields can go, because they are concerned, the Fed is concerned, if they hike rates too soon, they could counteract the effects that they've had with the stimulus by lowering borrowing costs. The strengthening dollar could reduce exports and further, and frankly limit growth in the U.S.
Well, and just about 20 minutes ago, we talked to Jim Bianco, who is sort of a well-known Fed skeptic, and he says every time we have seen the end of quantitative easing, stocks have fallen and the Fed has come back in. Mike, do you think that that's a perception at all? I mean, it doesn't seem to be sort of conventional wisdom right now among stock investors.
It was, obviously for a long part of this rally, you always thought, well, the Fed's going to be there no matter what. Right. And really, as Lisa was saying, if you look at the dollar, the strength in the dollar, that's something that everyone's really going to be keeping an eye on now. Obviously, if you're a multinational U.S. Company, that's not the best thing for you. Your goods overseas all of a sudden are a lot more expensive. So, does the Fed, have to be beholden to the exchange rate on the dollar now? And it's a good question. It's something they haven't talked a ton about, but it's certainly something they'll probably take a look at.
And I think that what's driving the sell-off, too, is there's a feeling of artificiality in these markets, that things are at a level that they should not be, and that people are waiting. They don't want to be the last one out, whether it's the stock market or the bond market. They do not want to be holding risk when the market right-sizes or starts to go back to whatever the normal is. Right. So that's part of what's driving this, too, is people are skittish. They're saying these levels don't feel real.
And that's why you get this volatility that a lot of people have been calling for a while. Thanks so much, guys. Lisa Abramowitz, Mike Regan, talking to us about the stock and the bond market.